G'day folks, welcome to the video. In this one I'm going to talk about the Plenti P2P lending platform. I'll go through some of the features of how it works, we'll do a bit of a walkthrough on the website, we'll discuss some of the features, and we'll finish up with me sharing some of my opinions on whether it's a good investment or not. Now, P2P lending stands for peer-to-peer. It basically means more or less cutting out the bank as the middleman and having one person as the lender lending directly to another person who is the borrower. And by cutting out the bank, the idea is that both the lender and the borrower get a better deal because you haven't got the bank in the middle taking their big fat fee. So the biggest concern for lenders looking to get into P2P lending for the first time, or any time for that matter, is how secure is their loan? Are the people borrowing money from the platform? Are they vetted? Are they running credit checks? What is the likelihood of default, and so on? So the biggest thing that Plenti uses to alleviate lender concerns is the fund that they call the provision fund. Now, when someone borrows money using Plenti, they will pay a little bit extra on the interest rate, and this little bit extra will go into the provision fund. The provision fund, like I said, is funded by borrowers, but it's important to note that there is no guarantee that if there is a default, that the lender will be protected. It's there to protect the lenders, but there's no guarantee that Plenti will pull money out of the fund and give that money to the lender. Now let's have a look at what it says on their website about the provision fund. So the provision fund may help you protect your investment. Not will, but may help you. While we only match investor funds with loans to creditworthy borrowers, we appreciate that in some circumstances borrowers may be unable to repay their loans. That's why we set up the provision fund, a pool of funds held in cash by a separate trustee, designed to protect investors in the event of a borrower missing a payment or default on their loan. Another thing people might be wondering is, are the loans secured? Well, they may be secured, some are, some aren't, and you cannot choose whether you lend money to a borrower on the basis of a secured loan or not. So the loans are typically used by borrowers for consolidating debts. So they may be taking out a loan with Plenti at a lower interest rate to pay off, say, a few different credit cards at a high interest rate. It's also used for car purchases, home renovations, and the clean energy fund, which is basically when a house wants to put solar panels on their roof and they don't have the money to pay for it up front, the solar company will allow you to take out a loan via Plenti to get this done. So Plenti perform credit checks on their borrowers before they enable them to borrow money using the platform. So let's have a look at what their website says here. So it says, we only lend to creditworthy borrowers. Every borrower must pass our comprehensive credit screening process when applying for a personal loan, car loan, or renewable energy loan. Our in-house credit team uses a combination of innovative technologies and traditional resources such as credit bureau information to assess each borrower's credit risk. So that's good, that's what you'd expect. And they also at times will engage debt collectors to chase money from borrowers who are defaulting on their loan. But they've also said that this is used at their discretion. It's not used all the time, but it is an option to use if they feel, I guess, the likelihood of getting the money back is going to be better than the cost of paying the debt collector to go after the money. Another protection in place for the lender is that you may be able to loan to a pool of borrowers, not necessarily to one borrower in particular. So that basically means by spreading the risk, you potentially can lower the risk of default and getting your money repaid and your interest as well. So, but that's not guaranteed. So let's have a look at the website. This is actually from their PDS and see what they have to say about it. So how many borrowers am I lending to is the question. And their response. When you make an order to lend money in a lending market, your lending order may be matched to a single loan or multiple loans. This will depend on the rate of your lending order, amount of your lending order, the time your lending order was made relative to other orders in that lending market, and the number and amount of loans available to be funded in that lending market. So You know, obviously, if you can lend to a bulk of different borrowers, that potentially can reduce your risk, but there's no guarantee that that'll be the case. Now, in most cases, you're going to be lending money out to individuals rather than businesses. There will be some business lending. I'm thinking mostly this will be the case if a business buys a car and takes out a car loan, but for most cases, it will be to individuals. And when you earn your interest, Rate Setter will take, or Plenti as it's known now, it used to be known as Rate Setter, they will take 10% out of your interest as what they call a margin fee. So that's basically your fee in the middle. You're paying 10% on what you earn on that, so you get to keep 90% of the interest. All right, guys, so now we're going to jump onto the website. We're going to have a look at what they have to say in more detail, and we'll have a look at some of the features of the provision fund. All right, so here we are, guys, on the Plenti website. You can see here they've got the mobile app as well. I usually use it from the computer. It's a bit easier for me. So straight off from the top here, it says earning attractive returns from 6.5% per annum. So this is on the investor section, not the borrowing section. And in this video in particular, I'm talking more about the perspective of the lender as an investment. So attractive returns of up to 6.5% per annum, investing in consumer loans. Let's scroll down and see what else they have to say. Getting started with as little as $10 at 6.5%, 20,000 plus registered investors, 700 million loans, 100% of principal and interest returned. That's very good, and it's asset regulated, of course. Capital at risk. So no guarantees here, guys. Attractive rates for investors, 5-year income paying 4.8%, a 1-month rolling investment, 1.8%, 3 years at 2.8%, and the National Clean Energy, this is for the solar panels and that sort of thing, 3.4%. So the best rate you can get is the 5-year at 4.8%. So here they're talking a little bit about the provision fund. And we'll come back to that in a second. Talking about the registration process. So basically you register with them, you got to do your ID check, and then once you're on the system, you can transfer your funds in via BPay. That'll take a couple of days usually. And then once the funds are on the platform, you can invest in your loan. And you can choose to do your term, like I said above, which is quite handy. Your 1 month, your 3-year, your 5-year. They used to do 7-year as well, I'm pretty sure, but they don't do that anymore. Australia's most loved consumer lender, eh? Okay. And then we move down into the FAQs and that sort of thing. So I'm going to jump over to the provision fund page now for some more detail on that. So it says here, Plenti's investment model has ensured every one of our investors has received 100% of their principal and interest payments. And that has been, I think, very important, particularly in the early days when they were starting up, because P2P was very new. Lenders didn't necessarily have confidence in this because there's no banks involved, and they needed some kind of guarantee or assurance that if a loan is defaulted on, because it does happen, of course, that they aren't going to lose all their money. So that's where the whole provision fund came from, and it's very good to know that to date they've paid out 100% of principal and interest payments, but there is no guarantee, as it says here. However, it is important to remember the provision fund is not a guarantee nor an insurance product. So this was very important in the early days, like I was saying. It'll be interesting to see how things go later on, now that the platform has received critical mass. It's floated on the ASX, so it's well and truly up and running. And now that more lenders have moved in and more borrowers have moved in, what will be their reaction if things do default and so forth? Will they maintain this 100% payout, or will they let that drop off a bit now that the platform has critical mass? That will be interesting to see. So we can see they've got 20 million in the provisional fund. The current estimate of bad debt is 11 million. So the coverage ratio is 177%, or nearly double, but not quite, being 11 million, and they've got 20 million in the fund. 100% paid out, as we've already mentioned. Only lending to credit-worthy borrowers, we've been through that. May help you protect your investment, yep. Designed to reduce the risk of consumer lending. All borrowers pay an amount into the provision fund. That's that I mentioned at the top of the video, that comes from the borrower's end, not the lender's end. So here's a breakdown of the actual fund balance. So the fund buffer they're quoting is 20 million, but really, if you look at this, they only have 13 million. And the estimated bad debt is 11 million. So they still covered it, but only just. But then they've got expected inflows here, another 6.5 million. And it says this represents the current contracted borrower contributions to the provision fund due to cover the lifetime of loans adjusted to reflect expected early repayments, payment holidays, and bad debt. So they're expecting another 6.5 to come in to get it to 20 mil, but really at the moment they only have 13.9 mil. Still more than the expected bad debt, but maybe not quite that 1.77 or 177% coverage. So you got to look into the detail on this stuff, guys. And they're very upfront about, it's an investment. Every investment carries risk. Plenty is not without risk. No provision fund protection potentially. So there's some good information here, and they've got the PDS, of course, which you should definitely have a look at. No deposit guarantee. Now, Plenty has been around for a few years already. Back in the day, until recently, it was known as Rate Setter. And in the early days, they really did offer lenders a better deal. I guess they kind of had to get lenders onto the platform. But back in the day, they were offering around 9% for the 5 and 7 year loans, as you can see here. I guess as things have progressed for them, they had a view to listing on the ASX, to going public with the company, and they wanted to, I guess, cater to a broader aspect of the community and to bring on more borrowers. So what they've done with that is they've put in a cap on interest rates. So like I mentioned, back in the day, you could get up to 9% around that mark, which is very good, but obviously being an early investor, that carries more risk with it, and the interest rate reflects that level of risk. Higher risk, higher reward, as they say. So what they've done, they've actually introduced a cap. So they're bringing this cap now that is at 6.5% on the 5 year rates. So that's the highest you can ever earn now as a lender, which is interesting. I guess it's good for the consumer, not as good for the lender. But I guess in a way, if it means that you're earning less, but there is more security on the platform, that the risk of default is lower, then it may not be such a bad thing. Now, I'm not sure if the lower rates that you get nowadays is a result of the platform going public and bringing on a lot more lenders and therefore increasing the supply of money and bringing the cost of money down. That could be one thing. But also, I'll show you here that the current rate on a 5 year loan is 4.8%. So that is still, quite below the cap of 6.5%. So that would suggest that probably there is less demand for the money, being that there is more money available. But, we'll see how it goes. It'll be interesting to see how it plays out in the next couple of years, especially now they are public, because this only happened quite recently. Now, some of the things I like about the platform is that it does give you the potential to earn a higher interest rate than you will earn with the banks or with other products on the stock exchange, be it dividend yields and things like that, or listed investment trusts. It also offers some good flexibility in that you can lend for 1 month. If you're not so sure, if you just want to, dip your toes in the water and see how it goes, you can lend for 1 month, see how it goes. That's sort of what I did when I was starting out. You got the 3 year, you got the 5 year. clean energy fund if you want to do some more ethical investing. And so it allows you to match your risk to the term, but also the amount that you want to earn as well. So that's quite good. It also has some good rollover options. You're able to take the interest out every month. You're able to sort of redirect the interest from a 3-year loan into the 5-year loan or vice versa. And you're also able to just roll over into the same fund. So there's some pretty good options there. So you can just roll everything over, or you can get paid in your bank every month. Another thing, I guess, is that it's just a good alternative to what else there is out there on the market. You know, it's I guess an alternative kind of investment. It's pretty new. If you're looking to if you're a bit worried that the stock market might be overvalued, and you're a bit worried about the other options, government bonds are, you're not making much on them these days. If you want to try something new, this can be a good option. Maybe a small portion of a portfolio. I'm not a financial advisor here, guys. I'm just talking to you how I think. And obviously you got to do your own research and do what is comfortable for you. And of course, having the monthly payout option is really good as well. When you can earn monthly cash flow at a reasonably good rate, because your alternative, if you're investing in dividend stocks directly, you're probably only getting your dividends twice a year. If you're investing in ETFs, you're probably getting paid 3 or 4 times a year. So to have that money coming in every month, month after month from Plenty, that is very nice. And as I've touched on before, it will be interesting to see how things play out in the future and how it changes, because in the past, they definitely were geared more to the lender, offering high rates, quite attractive rates up at 9% like I showed you before. That's quite good coming in every month. But now, especially since they've gone public on the ASX, it looks like they're starting to pivot a bit more to a borrower-consumer focus. So it'll be interesting to see how that goes, whether they strike more of a balance or whether they keep going more to the borrower side. I guess like all parties have to be happy for the platform to be viable, but it's just something to keep your eye on, because things have changed a bit with it over the last year or so. In my view, the interest rate offered to lenders is starting to get into borderline territory, whether the rate is enough to compensate the risk involved with the investment. Currently at 4.8%. Look, it's reasonable, but there are other options out there with listed investment trusts on the ASX that pay more than that. Of course, everything has its own risk and you got to look into that, but there are other options out there. But considering there's no guarantee as such, the loans aren't secured in a lot of cases, and the general market uncertainty that there is around all of the lockdowns and recessions and everything going on at the moment, a high interest rate probably would be welcomed. It's probably okay, but it wouldn't want to go much lower. So now we're going to jump over to ratecity.com.au to see how it looks from the borrowers and in comparison to other lenders. So as we know, the 5-year rate for a lender is 4.8% at the moment. This is in April 2021. And you can see here, they're highlighted at the top, so they're pumping a bit of money into their marketing, and they're offering the 5-year loan at 6.39% to the borrower, or 4.8% to the lender. So there is a bit of a spread there, which is probably bigger than I was expecting. We know that some of that will go to the provision fund, but I guess the whole point of P2P is that you're cutting out the middleman. So maybe I would expect a slightly lower spread there, but that's what it is anyway. That's interesting. So let's see what else there is in comparison. So you got 6.39 for Plenty, 6.49 here, 5.4. Yeah, so they're about, they're competitive with what else is out there. All right, guys, so I've been doing this for a few years and the results have been good. I've been very happy with it. Never had an issue. But the one thing I probably don't like about it so much now is the cap they've put on interest rates. In my view, if the market is dictating that an interest rate should be higher than the cap rate due to short money supply or risk in the market, then that's what the rate should be. That's what happens in an open and free market, but that is not the case here because they've got a roof on where the rate can go. So I don't really like that so much. In my opinion, it is still worth it to throw a portion of my portfolio at this, a small amount of money. I think it's reasonably safe, I think it's something you have to keep an eye on. It's not necessarily a set and forget, but you know, I think it's worth having a bit of a look at it if you are interested in this sort of thing and investing in some alternative assets for that monthly income. It's quite good for that. You know, if interest rates do drop a little bit more, I'd take a little bit more, but if they go a lot more, I probably will take my money out. I think 4.8% for 5 years is reasonable, but it could be better, but I wouldn't want it to be much lower. If it got down to sort of below 4%, I'd probably take my money out and put it elsewhere, but we'll see how things go. All right, guys, so wrapping the video up now, this has just been a brief overview of my personal experience with the platform. I'm not a financial advisor. I'm not making recommendations here. It is very important that you do your own research. They've got pretty good information on the website, but I recommend, or you know, you definitely should read the PDS as well, because that's where you get the detail and that's where you find out exactly how things will work if things don't go the way you expect. Like you should for any investment, read the PDS. You know, it's still a relatively new concept. It is interesting. It is worth keeping an eye on. You know, the alternatives out there with term deposits aren't so good. You know, you can argue that the share market is looking pretty overvalued. So, you know, it's probably not a bad place to put a little bit of your portfolio and see how it goes. But yeah, so that's pretty much it, guys. So give the video a like if you got something out of this, if you learned something, if it helped you at all, I'd really appreciate that. Subscribe if you'd like to see more videos in the future, and we'll see you in the next one.